Well, what's going on YouTube? In this video, we're going to talk about Caterpillar, ticker symbol CAT. Year to date, this company's up 14.8%. Over the course of 1 year, this company's up 68.6%. So, Caterpillar manufactures and sells construction and mining equipment, and diesel and natural gas engines, and industrial gas turbine worldwide. So it's got quite a large business. Its construction industries segment offers asphalt pavers, backhoes, loaders, compactors, coal planers, compact track, and multi-terrain loaders, excavators, motor graders, pipe layers, all sorts of, heavy machinery and equipment. So where I live, Caterpillar is everywhere when it comes to the big construction job sites. So let's look through the financials on Caterpillar here. Right off the bat, we can see Caterpillar in the last 7 years is actually at or near all-time highs, relatively close. Had a little bit of a pullback here too. So we're gonna look at our revenue, gross profit, and income. We can see our revenue is starting to grow. Since going all the way back to 2014, looks like we're probably at, I would say, all-time highs in terms of revenue. Net income is starting to grow a little bit. However, our gross profit is starting to grow a little bit, but our net income is kind of flat. I really would like to see that grow kind of with these two, at least grow with the gross profit minimally. We can see our gross margin sitting above 30%. Nice. Our net margin sitting 10, what is that? 12, 13%. So it's actually in the last, 9 years, it's at all-time highs and on net margin. So that's good to see. Revenue and gross year-over-year change. We can see our revenue is year-over-year is still continuing to grow, and our gross profit is also still continuing to grow. Return on invested capital, same thing, just kind of slowly growing, getting higher. It's at above 15%, which is my number one, not my number one, but my biggest thing, one of the things I always look for in a company is where's their ROI? It's almost got to be above 15% for me to want to invest into that company. Cash to debt. We have a boatload of debt and not a whole lot of cash. Something to potentially dig into deeper, although if you look at their debt, it is just stagnant right around that 60 to 70 bill range. And our cash, same thing, is stagnant right around 7 to 8 bill. So they've obviously been able to operate their business like that for many, many years, and has been continuously that's just where it is. That's how they like it, apparently. Their net income to free cash flow. Their net income is slightly more than their free cash flow, which is always good. Whenever their cash flow is above their net income, I question that. I wonder why our net income or if our cash flow is more than our net income. Because you think your net income is what you made from the business, that's what you get to keep. There's a few things companies can do to make their cash flow grow more than their net income, and sometimes that's not always a good thing. So whenever you see that, I always want to dig deeper into that, but we don't have that problem here. Our net income is above our free cash flow, so everything checks off okay there. Free cash flow, again, we can just see this growing nicely. Very, very nice, steady uptrend on the free cash flow. And then our share count is slowly declining. Another fantastic thing to see. Over here, we have four other companies to compare to. We have DE, PCAR, CMI, and I believe that's Komatsu. Unfortunately, Komatsu is not loading over here, but we'll continue. So right off the bat here, we have a price target on analysts of $270 per share, and we know this company is trading above $270 per share. So we already know analysts are forecasted to see this company at $270 a share and is trading above what their price target is, and this is based off of 18 analysts. So I'm gonna pull Komatsu off of our peer list because it's kind of throwing all of our charts out of whack. Yeah, we're gonna get rid of that one. So we only have 3 peers to compare to, and that's okay. So what we got, market cap for Caterpillar over here is on the left hand side of all these charts. Market cap on the right hand side is going to be revenue. So we can see we are the leader of these other 3 peers. Comparisons, competitors. Caterpillar is currently the leader, and they also produce the most amount of revenue as well. However, if you look at DE, their revenue is at 61 billion. Caterpillar is at 64 billion, so they probably have a better net income percentage. So that might be something to look into. Gross profit and income. You can see we have our revenue, gross profit, net income. All three. We can actually see DE has a higher net income than Caterpillar does. So, there's a chance DE might be better financially, especially in turn, with income and how they make their money. So that a DE could be a good one to look into. Just because it has a lower market cap doesn't mean it's not a better business. 5-year growth, we have our EPS. These are based on analysts here. For the next 5 years, our EPS and revenue growth. Pretty big EPS growth across the board, along with 5% roughly EP or revenue growth. DE is lower in revenue growth. Caterpillar is a bit higher in revenue growth. Gross margin, we can see right there. It kind of tells you where DE is at. Is has a higher gross margin than what Caterpillar does. Operating margin, Caterpillar. I mean, these are still really good gross margins and operating margins. Don't get me wrong. It just DE is a little bit better here. And then our profit margin, again, this is DE is above 15%. It's another one of my big key components to investing into a company is having a profit margin above 15%. So I like that. I like to see that. But again, Caterpillar doesn't mean Caterpillar is not a good business to invest into. Our free cash flow, fantastic free cash flow over here. That's another big key component, right? Is you want to make sure that this company is generating enough free cash flow to pay off their debt, potentially do dividends or increase their dividends, and all they've got 5 different areas they can put their money into, right? So return on invested capital, 15%. DE is a little bit lower on 15 or below 15 there. PE, we have the highest PE on Caterpillar. The rest are sitting about 12 to 13 for PE. So Caterpillar is obviously the most expensive one of the bunch. I think DE is worth looking into, which is John Deere, by the way. Calculators, Peter Lynch valuation. We get $390.06 per share with the Peter Lynch valuation. Multiples comparison gives us $219.57 per share. Price to book, we are well above our 5-year average on our price to book ratio. We're sitting at 7.7. Our 5-year average is 5.4. PEG ratio, we're overvalued currently at 2.2%. Forward looking, we would be fairly valued at 1.7 on the PEG ratio. Graham's valuation gives intrinsic value of $467.86 per share. Our discounted cash flow valuation, I gave them a growth rate of 10%. Our discount rate is 6.67%. Analyst growth rate is 14.4%, and our average growth rate is 9.1%. And the reason I gave them 10% is because look at when we go back to these charts here, we can see their free cash flow at how just steady it's grown. We did get a big jump here, but it's very consistently higher. So I feel that 10% is a pretty fair number. 14 could be even better for this company. 14 could be more accurate, but I like to just be a little conservative if where I think it's necessary. So our discount cash flow per share is $229.24. Down here, Rule 72, our last valuation method. We have our EPS, our current PE. We have 3 different EPS growth rates among 3 different sources. It gives us an average growth rate of 18.18. 18.18 goes into 72, 3.95 times. 3.95 goes into 10 years, 2.52 times. So what we get to do is double our current EPS 1 time, 2 times, and half a time. However, I'm not going to double it that half a time because I feel like 74, we can come over to here. We can see our fair value then is going to be $672.82, 30% margin safety, $470.98. So if I was to kind of split this down the middle, you're talking maybe, 90-ish EPS, it puts you at a fair value of $818. So I'm going to keep it back at like 74, I believe is what I had it at there. So, and I feel like that's a pretty fair number. So now we get to our summary of all of our numbers to figure out a fair market value for Caterpillar. And Caterpillar's fair market value is $276.91. We get to average of our valuations that we did here, and that gives us our fair market value. And then with a 30% margin of safety is $193.84. Again, analyst price target was $270 per share. So the valuations we just went over and analyst price target compared to the current trading price of this company is trading exactly what it's worth. It's trading at its fair market value. So this is one of those companies you just kind of personally, wait on the sidelines and wait for a pullback, a 30% pullback in this company right now. If we can get it below $200 again, that would be a fantastic buying opportunity on Caterpillar again. But that's just one side of the fundamentals. There's always another side of the fundamentals, and that is the news and the forecast of the company and how what the CFO and the CEO are telling you about the future of the company. Read those things. Figure out if this is a company that you find interesting, because there's a lot of good things that could come with this company. There's obviously we got AI. There could be some AI potential within Caterpillar. So I mean, it shouldn't just stop there. It should also include a little bit of news and a little bit of further analyzing, but that is a lot of opinionated stuff. So that's why I don't typically include it, because my opinion is my opinion. So over here at the stock chart, we can see Caterpillar has been just in this nice clean uptrend. We're on the weekly chart here. We could probably do a trend line from this low and up to something like that. So we're just in a nice clean uptrend. A bit steep though. We're probably maxed out in the meantime. I don't know. We might pull back. It seems like we could be hitting at the top of a channel here, which it really seems like we are. So if you draw out something like that, we're probably going to pull back, which would be perfect. Although it's not likely, it won't pull back far enough to hit our 30% margin of safety price range on this company, unfortunately. But that doesn't mean a pullback to this trend line is not a good buying opportunity to say, if Caterpillar pulls back to $240 a share, I'd probably play it. I buy it and, see if it doesn't come up higher. And especially if you're planning on buying this for a long-term hold, I mean, I do believe this is a dividend paying company, so that would be, a good potential investment. And they do pay a 1.9% dividend. So, but that's my take on Caterpillar. I think Caterpillar is worth a deeper dive for sure. I think all the financials look good. The technicals look good. I think actually it's due for a pullback in the future for sure. It could resume higher, but it looks like it needs to rest and pull back down to probably the bottom end of this trend line here. Maybe in this 240 range, like I said, might be a perfect buying opportunity on Caterpillar, and then ride it back up. It does look like it is consolidating right here, and this is usually a time when, you know, uh, once you start seeing consolidations, that's usually when it either consolidates, breaks out, or breaks down. And usually when you're at the top of a channel, you're probably going to break down. So that's what I see in Caterpillar. Caterpillar to me, nothing wrong. I like the company. I like the stock. And I will probably look to, if it pulls back to 240, I'll probably be a buyer at 240 and be a seller again somewhere maybe in the upper 300 or lower 300s. But that's it on Caterpillar. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.